Today is the 21st of March 2020. My name is David Hickson and I am coming to you from behind quarantine again. I am living in Italy and of course the whole of Italy is under lockdown. I hope that wherever you are keeping healthy and staying safe. In today's video I am going to be speaking about cycles and market panic. It's not often that I record a video on a Saturday, and the reason I'm doing it is because the markets closed in a very worrying position on Friday, and I felt it was important that I recorded a video over the weekend. I hope that you have had an opportunity to read and make sure that you have understood these disclaimers. And so let's take a look at the markets. In my previous market update, I took a look at the peak analysis and spoke about the magnitude of this peak, which I mentioned I believed was probably of at least 9-year magnitude. Now, in today's video, I'd like to go back to the trough analysis. The trough analysis, as you probably know, is always in a stock market the more reliable analysis, because Hurst discovered in the 1970s that the cycles that influence stock markets are synchronized at their troughs. And so let's focus on this trough analysis, and I would like to consider what the magnitude of the trough is that we are heading down into. Now, in the previous market updates that I have done over the past few months, I've been speaking about the fact that the market's expected to turn down into a trough in about the middle of this year, and by which I mean that the trough is expected to form in about the middle of this year. So what is the magnitude of that trough? That's the first thing I'm going to speak about in today's video, because it's a very important consideration. So this is the analysis that we've been looking at mostly in my previous market updates. I do track several analyses in all of the instruments that I am interested in, and I haven't dwelt too much on the minute details. But this is the analysis we've been mostly looking at. And the important points about this analysis are the fact that there was a 9-year cycle trough over here in early 2009 and another 9-year cycle trough over here at the end of 2018. And many analysts agree with this analysis. If we measure the time between those two troughs, you can see 9.82 years elapsed between those two troughs. A little bit long for a 9-year cycle, but not impossibly long. So I'd like to point out one of the problems with this analysis, and I'm going to come back and show an alternate analysis in a moment. One of those problems is that the 54-month cycle is phased in early 2014, and you can see there was hardly a trough at all in the markets at that time. And many analysts prefer an analysis which places the 54-month cycle trough over here in early 2016. So we're going to take a look at that in a moment. So this is one of the possibilities in terms of what is happening at the moment. And what this means, of course, is that the market is now coming down into an 18-month cycle trough in the middle of this year. That is the minimum magnitude of this trough, in my opinion. I received several comments and emails asking whether, if the 9-year cycle trough had formed in 2018, at the end of 2018, whether in fact that isn't quite good news, because it indicates that the markets have the strength to then really, bounce out of the trough that's going to form in the middle of this year. So that worries me a little bit, because I feel that I must point something out here, and that is that if the 9-year cycle trough did form in 2019, then the first 18-month cycle, this semicircle over here, the first 18-month cycle following the 9-year cycle trough should be the most bullish of all of these 9-year cycles into the next 9-year cycle trough. And so what has happened, as you can see, and perhaps it's time now to zoom in, what has happened since this trough over here in 2019 is that the markets have gone up, and let's just clear those semicircles. There we go. There's a reason I've zoomed in this weird sort of a way. But you can see that here is the M shape for this 18-month cycle. Now the 18-month cycle still lies ahead of us, so we still have some more time to get through before we actually get there. But the point is that even if the market doesn't drop any further from here, we already have a lower trough over here. And that is the worrying thing that occurred this week. We have a lower trough, which means that this is actually a fairly bearish 18-month cycle. Now, as I just mentioned, if this is the 9-year cycle trough that formed over here at the end of 2018, then the future 18-month cycles that need to play out must, by necessity, be less bullish than the one that we have just seen. And so that is very worrying, because the cycle that should have been bullish has turned out only recently to be a very bearish cycle. Well, not very bearish just yet, but it's looking pretty nasty. So that is one possibility. And now let's take a look at another possibility for the trough that we are heading into in the middle of this year. Here is the second possibility, which has the 2009 trough again as a 9-year cycle trough, and it has this trough over here in 2016 as another 9-year cycle trough. I've presented this analysis before, and I know that there are analysts who disagree with me, because this was a very short 9-year cycle at only just a little under 7 years. So that was a very short 9-year cycle, but again, not impossibly short. So this is a possibility. And there are some things that I quite like about this analysis, in particular to do with the shapes of the 18-month cycles. So now, following the trough of 2016, we have witnessed 1, 2, and we are now in the third 18-month cycle. Okay, the shapes of those 18-month cycles are roughly like this: a very bullish 18-month cycle, which is what you would expect following a trough of the 9-year cycle. So a very bullish 18-month cycle, then a fairly neutral or ever so slightly bearish 18-year cycle that played out next. And that would then be followed by the most bearish of the 18-month cycles. Now, this analysis is one that I've shown before. It isn't one we've been focusing on, because at around about this time, late 2018, this analysis was probably my favorite analysis, and I was speaking about it. And I pointed out at the time that the next 18-month cycle would then be the more bearish, or the most bearish, least bullish of the sequence of 3 18-month cycles. And of course, as the market moved higher and higher and higher, the fact that this was going to turn into the most bearish of the 18-month cycles seemed extremely likely. How much has changed in just a few weeks, because this strong move down has now turned this into a bearish 18-month cycle. This analysis, in my opinion, still a very viable one, indicates that we are heading down into a 54-month magnitude cycle trough. So that would certainly explain the rapid move down that we have experienced recently, if it is moving down into a 54-month cycle trough, because that's a much more powerful cycle trough. But now, again, let me point out, does this mean that we have good news? Are we going to see a good bounce out of the 54-month cycle trough? Well, yes, of course we are expecting a nice bounce out of the 54-month cycle trough that's going to form in the middle of the year. But how much of a bounce are we going to see? If this was a 9-year cycle trough that formed in 2016, then if you take a look at this red semicircle, that gives us an idea of what that 9-year cycle is actually doing. It was moving up and potentially formed a peak over here. Another support of the argument that probably is a 9-year cycle peak. And so what is that 9-year cycle doing now? Well, of course, it is moving down. And so although we would expect a nice bounce out of the 54-month cycle trough, if it is a 54-month cycle trough that is going to form in the middle of this year, of course, we are expecting a more bearish shape to form, taking us all the way to the next 9-year cycle trough, which is expected in about 2025. So in other words, we're generally looking at a change of mood in the markets that's going to last for several years. Now, one way of visualizing an analysis is to use the composite model line, which I've shown many times in these market update videos, so I won't dwell on it too much. This is the composite model line for this analysis. And the interesting thing about this composite model line, well, you can see it indicates the market's expected to give us a little bounce now and then come down into the deeper trough in the middle of the year. You can see that, of course, we're expecting that bounce out of that 54-month cycle trough, but then the tone of the market is very much downwards into the next 9-year cycle trough, which is why, in my opinion, the tone of the markets has changed, not just for a period of several weeks, not really even for several months, but indeed for several years. Let's take a look at a third possibility for the magnitude of the trough that is forming in the middle of this year. Here is the third possibility. It's a slightly unusual one, and so it's not one I've spent a lot of time speaking about, but it marks the 2002 trough as being a trough of the 9-year cycle. And then it places this rather unusually positioned 9-year cycle trough in 2011. Now, I recorded a video with Sid Norris. It was must have been a few years ago, in which we discussed this analysis in some length. It's a very interesting possibility. It's slightly unusual, and I know many analysts reject it. But one of the results of this particular analysis is that we have the 54-month cycle trough over here in early 2016, which does make quite a lot of sense. And if this is the correct analysis, then the trough that we're heading down into is going to be of 9-year magnitude. So this looks to be perhaps the most positive potential analysis in terms of what's going to happen in the longer term. However, again, even if this is a 9-year cycle trough that we're coming down into in the middle of this year, the upward side of the current 18-month cycle is now complete, and the future holds the downward side of that much longer cycle, which is probably the 18-year cycle. And so we're looking at, again, more of a bearish tone to the markets for many years to come, even if this is the 9-year cycle trough that we're heading down into. So those are the possibilities, in my opinion, of the trough that we're heading down into in the middle of this year. Now, if it's going to be a 9-year magnitude trough, then that is very worrying indeed. Now, the way that I approach Hurst cycles is not to make a hard decision about the magnitude of the trough that we're heading down into, because we could argue any one of these particular analyses. And so this is the approach I take, and it's time for us to zoom in and consider the finer detail of what is happening. So this is how I approach it. I believe that the trough that we're heading down to in the middle of the year is at least an 18-month cycle trough. It might be a 54-month cycle trough, or it might be a 9-year cycle trough, but it is at least an 18-month cycle trough. And so I'm going to be taking a look at this analysis where, as you can see, we have the 18-month cycle nest of lows. But more important than trying to make a hard and fast decision about the magnitude of that trough is to take a look at the detail of the price action. And that is what I would like to do now. And that detail is worrying in my opinion, but let me show you the evidence and then you can decide for yourself. So as you will know if you've seen my previous market update videos, I believe that the 20-week cycle trough almost certainly formed on the 31st of January. Over there you can see the pin mark where I have influenced this analysis. And so that is the 20-week cycle trough in my opinion. That means that since then the market should have formed a 40-day cycle trough, and here is the circle for the 40-day cycle trough, and as you can see it's floating above this 20-day cycle trough. Now why is that happening? Well, it's happening because Cent Trader is struggling to accept that this fairly obvious trough that formed in the markets literally just a day before it was expected to form, that trough is the 40-day cycle trough. Why is Cent Trader struggling to accept that? Because of the very miserable bounce out of that 40-day cycle trough. And this is what I want to focus on for a moment. When we are looking at a market that has had a Hurst cycles analysis performed on it, we can of course do things like displaying the FLD and so forth, and we look at the way that the market is reacting to the cycle's influence. And this is why I have called this video Cycles and Market Panic. Cycles have worked for years and years in financial markets. Quite an interesting thing happens. I'm often approached by people who seem to feel that I should be trying to prove to others that cycles exist. I don't feel the necessity to prove it because I've seen enough evidence, that they do exist and that they do work, and that there is definitely some kind of a cycle action that influences these prices. But what tends to happen is that cycles work very well and are very clear in what might be called a normally balanced market, in a traditional open outcry market where the prices are not manipulated. Or, I don't want to use the word manipulation perhaps because that's rather a loaded word, but a market where prices are the result of a fairly normal process of buying and selling. When a panic sets in, and we have begun to see the beginnings of a panic, and I am saying the beginnings of a panic. I'm very worried things are going to get worse, and I'm going to point out a few things in a moment. So when a panic begins to seize the market, we begin to see some unusual things happening. And one of the things that happens is that although the cycles are still influencing the markets, they tend to get overshadowed by what might be much longer cycles, but also just by the sheer emotion that comes into the market as the world is seized by this panic. And of course the drop in the markets is being blamed on the coronavirus. In my opinion, the markets were certainly due to turn down and move into a trough. The fact that they've done so with so much force could certainly be blamed on what's happening around us. But the important thing to bear in mind is that when the markets are being seized by a panic, as we are seeing at the moment, you must realize that the cycles, while they will still be influencing the markets, will not be doing so with nearly as much efficacy as they do in a normal balanced market, which is why I was concerned by comments that I received saying, well, all we need to do is wait for this 80-day cycle trough, and then we're going to see price bounce out of that 80-day cycle trough, and then we'll be getting back up to a point where I can let go of my holdings in the stock markets. I must caution that we have to be really quite careful, and Hurst cycles, and particularly the interaction between price and this FLD, give us a very useful way of doing that, because we can measure the degree of bearishness, how much bearishness is in the market, and whether that bearishness is a result of the longer cycles, or whether it is in fact just a result of the panic that is seizing the market, we can't really tell. But the fact that the market bounced out of this trough over here at the end of February in such a very weak manner is an indication that the bearishness was very strong at that point. Now, I posted a video on this day over here, I believe, where I pointed out that the markets had turned bearish. There was a lot of bearishness that was beginning to reveal itself. Well, that was only the beginning, as you can see. So if that was the amount of bounce that we saw coming out of the 40-day cycle trough, and I haven't pinned this analysis to that point because I think it's quite useful to see the circle there. That's just a personal preference. But since then, we need to have seen a 20-day cycle trough form, and then of course we're looking forward to this 80-day cycle trough. So let me just add some bar counts over here. We have seen 49 days since the 20-week cycle trough at the end of January. The average length of an 80-day cycle is 68 days. So we have about 19 days still ahead of us until this 80-day cycle trough is expected to form. However, recently the 80-day cycle has been running short, of course, because we have been in a bull market until fairly recently, and in a bull market, troughs tend to occur early. And so the average length recently has been 60 days, 61 days. And so we probably only have about another 10 days or 11 days until that 80-day cycle trough is expected. But nevertheless, we have some time ahead of us. Now, let's take a look at what else should have happened in the meantime, as it were. Let's count the number of bars from this probable 40-day cycle. There have been 21 days. And so we should have seen a 20-day cycle forming. Here is the circle. Let me just clear these marks. Here is the circle for the 20-day cycle. So we've been expecting a 20-day cycle. So we are able to constantly monitor the market and see how it is responding to the pressure of these cycles. It is quite possible that that 20-day cycle formed over here on Friday, the 13th of March. Maybe that was the 20-day cycle, in which case we saw a good strong move up for one day, potentially over the weekend. Who knows? That cycle continued influencing things a little bit, but it was a very small bounce out of that 20-day cycle trough. Otherwise, potentially that 20-day cycle trough only formed over here. That would have been on Wednesday, and we saw a very miserable bounce out of that, and now price has continued further down. And so what is happening to the bearishness of this market? Is it subsiding? No, it's increasing, and that's the really worrying thing. The bearishness that we are seeing revealed by the way in which the market is responding to the cycles that we know must be beating but have become quite hard to identify in this market. The way in which the market is responding is revealing an increasing bearishness. On top of that, as you can see, on Friday, the markets closed right down at their lowest point for the day. Your data source might differ slightly to my data source, but the point is it closed right at the very near the low of the day, and we still have 10 days to go to this 80-day cycle trough that is looming ahead. The bearishness has been increasing. I am concerned that we're looking at the markets accelerating downwards. And so prices are heading down into this 80-day cycle trough, which is expected. You can see there's the circle and whiskers for the 80-day cycle trough. Here's the nest of lows. It's a little bit scattered, but it's expected, within the next couple of weeks. But the important point really is that the bigger trough that we're moving down into, and let me zoom out as we consider this, is this at least 18-month magnitude trough, perhaps even a 9-year magnitude trough, which is a really big trough, but at least 18-month magnitude trough. And if we display the composite model line on just this sort of rather strange scaling that I've got over here, you can see that the composite model line is indicating a little bit of a bounce. Now it has two bounces in it because it is still expecting the 40-day cycle trough to form now. So that's that bounce, and so here is the 80-day cycle trough over here that is expected to give us a bounce. But look at how small that bounce is, and that's my point really, is that I'm a little worried that you shouldn't be holding on for that big bounce, and here's yet more of a decline into the really big trough that we're expecting in about the middle of the year. I do hope that you found this market update useful. Bear in mind my warnings about market panics and about how emotional market conditions can overpower the cycles, but remember to use your cycle tools to keep monitoring the mood of the market in terms of how bearish it is. Certainly bearishness seems to be increasing at the moment. So I hope that you look after yourselves, both in terms of your investments, of course, but also in terms of your own health. Look after yourselves, stay safe, and I look forward to hearing from you.